Welcome everyone to our first webinar in this series, and thanks for taking the time out of your day to attend. My name is Michael Steele and I'm a partner in the Business Services Division in our Cairns office, and I'm joined today by Lindsay Head, who also works in our Business Services Division as an Assistant Manager. Throughout the webinar, please feel free to submit questions in the questions pane on your screen. We will respond to any questions after the session concludes via email or telephone as needed. If you are experiencing technical difficulties, please click support or visit the hyperlink displayed on the screen. After today's webinar, you will be sent an email containing the presentation slides, a link to the recorded session, access to past and future webinars, and our contact details. This is the first webinar in a two-part series of information sessions we are currently running. At the conclusion of today's session, you will be provided with a link to register for our second webinar, which will run next Wednesday, the 23rd of September. Today we will be working through cash flow management and a step plan for businesses impacted by COVID-19. So without further ado, I'll now hand over to Lindsay, who will start with cash flow forecasting.
Thanks, Michael. Firstly, I want to briefly talk about what a cash flow forecast is, and I'll touch on the reasons why it's so important for a business to do a cash flow forecast. And Michael is going to elaborate on some of the points I raise in more detail. So what is a cash flow forecast? A cash flow forecast is really just a prediction of what could happen in the future. It can help you to essentially look into the future to see if there are any periods that are going to cause you liquidity problems. And a cash flow forecast considers a period of time in the future, and that can be a short-term period on a week-by-week basis, or it can be as long as 12 months. You usually don't do forecasting longer than 12 months because naturally, the further out you're going to be looking, the harder it is going to be to predict what's going to happen in the future. If you're forecasting over a 12-week period, for instance, the forecast should separate that period into 12 smaller intervals. So you might make those intervals week by week within that 12-week period. The basic structure of the forecast, you'll start looking at the cash balance at the beginning of the week. Say for week one, you've got your opening cash at bank that the business has. And then the forecast will then consider or predict all of the cash inflows of the business for week one. And then it's going to predict all the outflows of the business for week one. And then based on your opening balance, inflows and outflows, the forecast will then keep a track of your cash balance for that week. Then the forecast will then start again at week two with week one's closing balance, and so on and so forth. So I've mentioned inflows, and what I mean by this is it's the money that you receive possibly for on-the-spot sales for customers or professional fees. It can be for money you receive from your debtors for sales that you've already made. It can be for money that you receive for the sale of assets if you're planning on selling assets. If you've got finance, then it's the money that you get in from your loans during the period. And it can also be share capital from investors or your shareholders, or even just money that you put in as owner's equity as the owner of the business. Cash outflows can be things like supplies for raw materials, wages and salaries, which is usually a big ticket item for most businesses. The superannuation attached to those wages. If you plan on purchasing any fixed assets, then the money you pay for the fixed assets is a cash outflow. If you pay for any tax liabilities like income tax or GST, or even periodic tax instalments, those will all be treated as cash outflows. Any loan repayments that you make during the period, that'll be a cash outflow, and even dividends you pay to shareholders or money that you draw out of the business, that's a cash outflow. So those are just some of the examples of inflows and outflows with respect to cash, but what I've mentioned, that's not an exhaustive list. Once you've recorded all your inflows and outflows, you can identify if you're going to have a positive net cash flow, and that means cash inflows are greater than your outflows, or you might even have a negative net cash flow for the period, and that means your cash inflows are lower than your outflows. Long periods of negative net cash flow can lead to some serious problems and possibly even insolvency. Therefore, being able to predict cash shortages can provide your business with time to be proactive to resolve the issues before you ultimately run out of cash or have some serious cash flow timing issues. So that leads me into why a cash flow forecast is so important. Cash is an incredibly important part of business life, which means that a business can live and die by the cash that it has to flow in and out of it. So you want to know that your business is going to have enough liquid cash to be able to pay for the expenses that it has coming up. Cash flow can be the reason why a business gets into difficulties, so it's very important to be able to predict what costs it has coming up into the future, as well as predict the money that it's going to be receiving in the future with some degree of accuracy. I know it might sound very obvious to all of us, and you don't need me to tell you that you need money to pay for things, but even the best of businesses can run into cash flow problems, and most of the time it's because of poor planning, especially with changes to commercial and economic landscapes. And like I mentioned earlier, if you run out of cash, there is a chance that you could become insolvent. So it is incredibly important to be on top of it. In times that the business has periods where it spends more money than it makes and it doesn't have enough money in its bank account to cover that difference, the business should foresee periods like that and be prepared for shortfalls. If you have periods coming up in the future and you can see that your business isn't going to have enough money to cover that shortfall, you need to determine what you're going to do. Do you need to consider contributing some of your own money into the business, or you might even be able to seek finance from the bank to cover that shortfall? You might have an overdraft facility with your bank account, or you might be on good terms with your suppliers who can give you an extension in paying them. A cash flow forecast focuses on both inflows and outflows, and while watching expenditure might seem more important, the forecast can usually be useful to help you identify if you have an income problem. For example, you might identify that you have a problem with your customers paying you, so they might always be late in paying you, or you could just be providing them with payment terms that are too generous for you. I'll elaborate on this a little more later, as will Michael. If you're obtaining finance, a cash flow forecast can be a requirement by your bank to give them some assurance that you're able to service the debt that you have with them, and they may require you to keep updating that forecast regularly. This is a tool that you can use to help they'll use to help satisfy themselves of the recoverability of the loan that they have given your business, and to give them some sort of assurance that you've got some control over the cash activity within your business. And it's difficult to say what's going to happen, so it's important to remember that the cash flow forecast is a prediction. It's only a guide and it's only a tool that can assist you to plan for the future. It's not necessarily what is going to happen. I'll now go through some of the ways to help you limit your cash burn rate if you're in a negative net cash flow scenario. So a cash burn rate is the rate at which a business uses up its cash reserves. Put another way, it's the rate of depletion of your business's cash pool in a loss generating scenario. You might have recently heard this term in the news a fair bit. Many of the airlines have been keeping a keen eye on their cash burn rate while their planes are grounded during the shutdowns. The net cash burn rate is calculated by dividing your cash balance by your monthly net income. So for example, if you've got 100 grand in the bank and your monthly net cash flow is negative $10,000 per month, then you have 10 months until you run out of cash essentially. Many businesses have experienced cash losses during COVID-19, so it's important to make sure you're being proactive in making changes in the business before it's too late. Some businesses have been hit harder than others, And while businesses with low cash reserves or unstable cash flows at the start of COVID-19 are particularly vulnerable, even the businesses in good financial shape with larger cash reserves at the start of COVID-19 need to be wary, because we still don't know how long it will take for things to look normal or even know what the new normal is. For instance, businesses in tourism or seasonal sales need to pay close attention to their cash burn rate, because during COVID-19, the season may be completely lost rather than just delayed. And those businesses will need to make sure that they've got enough cash to last them through to the next season. And the cash burn rate is a good indicator that you can use to help you know if you've got enough cash to get you through the winter, so to speak. So we've included some tips that we can suggest to help you to avoid cash burn. Firstly, prepare a cash flow forecast so you've got an idea of what's coming up. And concentrate on your core business by focusing on the things that you know best and will make you the most money. If you're having short-term problems, focus on cash rather than long-term profits, and know when you might run out of money. And focus on the most profitable sales and those where you might get paid earlier, or even start taking deposits up front on larger orders. You might even be able to innovate and identify other sources of revenue within your core business. Try to make it as easy as possible for your customers to pay you. For example, a mobile payment option might get you paid faster if you're out on the field with the customer. So you can take a card payment right there and then. You won't need to worry about going back to your office or your depot, sending an invoice, waiting for them to pay you in 30 days' time, then having to chase them up if they haven't paid you. You might even be able to provide them with an incentive, like a discount to your customers for paying you earlier. So keep on top of the people that owe you money. For example, send invoices out on time and do follow-ups for your outstanding debtors. That might even mean picking up the phone and just doing a friendly reminder. If it's a big task, there are services out there that can help you automate your debtor follow-ups, and your accounting software might even be able to automatically send statements to your customers. Negotiate with your stakeholders early. So that might mean contacting your bank, your landlord or suppliers, or even having your accountant help you with negotiating with the ATO on outstanding liabilities. Your cash burn rate, that's going to give you a good indication of how much time you have left. And if you foresee a problem, then start being proactive as soon as you can. Make good use of your accounting software and your accountant. So these days, there are many add-ons that can link with your existing accounting software. They're great tools for this sort of thing. Your accountant should be able to help you and provide some assistance, or at least point you in the right direction. Next, we've got limit or eliminate discretionary spending. This is a fairly self-explanatory one. Cut out your Friday afternoon staff drinks if you need to. You can spend some time cutting costs by reviewing major expense lines, and you will know what your core expenses are within your business. For some, that might be wages. It could be electricity if you're in manufacturing. If wages is a big item for you, then you might want to avoid paying staff overtime in order to avoid overtime rates with them. These might be low-hanging fruit that you can pick easily. Make payments as late as you possibly can. If you've got 30-day credit terms, then pay on the 30th day, so you have the money in your cash reserves for as long as possible. This will help you build up a good buffer. While you might be managing your customers' debtors, on the flip side, your suppliers might even be managing you to get you to pay as soon as possible. So you might even be able to take advantage of some early payment discounts from them. You can spread out your expenses rather than paying in lump sums. For example, if you've got the option to revert to subscription-style payment methods for things like insurance premiums or software licenses, many vendors have that payment option these days. You can try to repair capital equipment rather than simply replacing it. You might even sell some assets if you no longer need them. Or consider leasing new equipment rather than paying for it outright if you're buying new equipment. or you could just delay the acquisition altogether until you're through the other side. Manage your inventory better. What I mean by this is you could start thinning out your stock on hand so you only have what you need. This is so not all your money is locked up in your inventory. Just keep in mind though that you might need to consider supplier delays during COVID-19, especially if you're importing stock from overseas. Michael's going to elaborate on inventory a little further later on. Federal, state and local governments have been providing grants during COVID-19, so you might be eligible to receive cash flow assistance. So check out what government support may be available to your business. And there's quite a lot of information on the government websites. These are all things that that you can do to help you manage your cash flow by increasing the amount and the speed in which you get paid, and to reduce the money you spend out of your business, at least in the short term while you're facing difficulties. So monitor your cash flow regularly, and you can do that by having a cash flow forecast. I'll hand you over to Michael now. He's going to discuss some of our some common cash flow mistakes, and it's also going to go through developing a step-by-step plan for businesses impacted by COVID-19. Thanks, Michael.
Thanks, Lindsay. For the remainder of the webinar, I will cover two main topics. Firstly, I'll run through some common cash flow mistakes that we as accountants often see in practice, and secondly, I'll run through a step-by-step plan for businesses impacted by COVID-19. Common cash flow mistakes. As Lindsay alluded to in his presentation, monitoring and managing your cash flow is an important and essential part of running your business successfully. Every business has some form of cash flow forecasting in place. Some methods are sophisticated, whilst others are not. For instance, there are businesses who make decisions based solely on what is in the bank account at that point in time. And whilst we don't recommend that approach, it is still a form of cash flow forecasting. As accountants and advisors, we deal with businesses across a wide range of industry sectors, and we see how different owners manage their businesses. Through those insights, we've identified a number of common cash flow mistakes we see in practice. The first common cash flow mistake we see is failing to plan. Knowing where you want to go is your starting point. Working out a way to get there begins with making a plan. One common element we see in successful businesses is a focus on planning for the future. In a financial context, this usually takes the form of running a continuous cash flow forecast to keep on top of cash flow, coupled with a budget which tracks actual trading results against a targeted profit result. Another common cash flow mistake we see is not setting aside cash for upcoming payments. One of the benefits of effective cash flow forecasting is that it helps ensure you have sufficient cash set aside for lumpy expenses such as tax and GST payments to the ATO. Having these expenses included in your cash flow forecast spreadsheet will help prevent this situation where a business owner withdraws what he thinks is excess cash from the business. One of the more common cash flow mistakes we see is clients not understanding the difference between cash and profit. This is a common issue, and it's very understandable that business owners can struggle with the concept simply because they're not accountants. At the end of this presentation, I'll provide you with information about how to register for our one-day cash flow forecast workshop. As part of this workshop, we will go through this concept in detail. In the meantime, I'll now just go through a very basic example to give you an understanding of the difference between cash and profit. So in this example, assume a company makes monthly loan repayments of $10,000. Assume also that each monthly loan repayment is made up of a $1,000 interest component and a $9,000 principal component. Of the total monthly repayments of $10,000, only the $1,000 interest portion is included in the profit and loss statement. The remaining $9,000 principal component reduces the loan amount in the balance sheet of the company. Over a 12-month period, therefore, Cash of $120,000 has left the bank account, but only $12,000 of that total is included as an expense in the profit and loss statement. Hopefully that basic example illustrates that the net profit recorded in the profit and loss statement does not represent the movement in your cash at bank over the period covered by the profit and loss statement. Another common cash flow mistake we see in business occurs when businesses spend quick and collect slow. This happens when you are paying your expenses quicker than you are receiving payment from your customers. Generally speaking, most people don't like owing money, and as a result, they will pay their suppliers on or before the due date. Whilst that approach is admirable, it can pose a risk to your cash flow. That occurs if your customers are not paying you by the due date. Strategies you can adopt to avoid this problem are to keep your customer invoicing up to date and avoid giving credit to customers who have not proved themselves to be creditworthy. Overestimating cash collection rates is another common cash flow mistake we see. Overestimating the rate at which you expect to collect payment from your customers will affect the integrity and accuracy of your cash flow projection. Our advice is, in the first instance, base your future collection rates on your historical collection rates. Having said that, COVID-19 may mean that historical collection rates may not be indicative of what will happen into the future, but patterns will emerge over time, and you will be able to incorporate those patterns into your cash flow forecast. Another common cash flow mistake we see is businesses carrying too much inventory. Depending on the extent to which COVID-19 has affected your business and the amount of stock you hold in your business, this could be one of the most important items you need to keep on top of. Tying up your cash and stock is always critical to a business that buys and sells goods, but it is even more important in the current economic environment. Regular conversations with your customers will assist you in ensuring you have sufficient stock on hand to meet their needs. Regular conversations with your main suppliers will help give you an understanding of their ability to supply the required stock lines and the timeliness with which they can meet those orders. It's not much good having advised a customer you can supply them with stock if you cannot source the stock from your supplier due to breakdowns in the supply chain caused by COVID-19. Another common cash flow mistake occurs when businesses don't maintain sufficient cash reserves. As a general rule of thumb, businesses should seek to maintain cash reserves sufficient enough to meet 3 months of operating expenses. Now, whilst that sounds like a very high bar, particularly in the current economic climate, it's a safety net your business should aspire to, as it will build resilience into your cash flow. Chasing deals is another common cash flow mistake we see. We tend to see this mistake in businesses where owners have a strong sales background. Whilst there are advantages in purchasing stock in bulk to secure discounted prices, there's little benefit in doing so unless you can convert that stock into cash collections within your trading terms. This is particularly the case in the current economic climate when maintaining cash reserves is essential. Another common cash flow mistake we see is when a business grows too quickly. Whilst this is not likely a significant risk in the current economic climate, generally speaking, when businesses go through a growth phase, cash flow is almost always put under pressure. The reasons for this generally include the need to hold high levels of stock. You might need to add additional staff and possibly an increase in your overheads. Whilst growth should result in higher cash collections for the business, there will be a significant time lag between incurring and paying for these additional expenses and collecting the cash from your customers. Business owners need to plan for this to avoid a cash flow crunch during the growth phase. I'll now move on to developing a plan for businesses impacted by COVID-19. The first step in developing a plan for businesses impacted by COVID-19 is to build your new world cash flow forecast. As Lindsay mentioned earlier, you can extend your cash flow forecast out to as much as 12 months if desired. However, in the current economic climate, the accuracy of your forecast will likely be impinged due to COVID-19, and accordingly, our advice would be to limit your projections out to 12 weeks for cash flow forecasting purposes. In building your cash flow forecast, you will need to consider what your new world may look like. For example, if one of your income streams is selling bus parts to tour bus companies, you may need to eliminate that service line from your cash flow forecast until COVID-19 restrictions are lifted and tour buses start operating again. You'll also need to understand if you are cash flow positive or negative over the forecast period. Put simply, if designed correctly, your cash flow forecast should show weekly cash at bank totals, finishing up with a final cash at bank figure at the end of the forecast period. If your cash at bank total at the end of the forecast period is lower than your current cash at bank figure, you are cash flow negative over the forecast period. So the next step, what do you do if you have a cash flow deficiency now or coming up, and identifying measures to correct that? In the event your cash flow forecast shows a deficiency, then to correct it, you will need to either reduce your cash outflows and/or you're going to have to increase your cash inflows. In terms of reducing your cash outflows, the levers available to you include identifying discretionary or non-essential spending and eliminating it immediately, identifying overheads you can defer, adjust or remove, and identifying capital outflows to defer or adjust, for example, loan repayments and planned capital expenditure. The next step in developing a plan for businesses impacted by COVID-19 is to engage with key stakeholders. The first step in engaging with your key stakeholders is to identify who they actually are. For most businesses, the key stakeholders will include customers, suppliers, employees, your bank, and your landlord. The discussions you have with your key stakeholders should address what they will need from you and what you will need from them. Your accountant will be able to assist you in having those conversations, and when engaging with your bank, a report prepared by your accountant on your current financial position will bring some credibility to those conversations and negotiations. Step 4, consider options to secure additional capital for your business. If required, you may need to consider injecting more capital into your business to assist in navigating your way through COVID-19. In the event you are seeking to secure additional capital from your bank, you're going to need to bring your bank into the tent. In preparation for those discussions, you should determine what equity you have in secured and unsecured assets prior to meeting with your bank. The reason for this is that if your bank is going to agree to provide the additional capital, they're going to need to secure the additional funding they provide. Having an answer to that question up front will make those conversations easier. As an alternative to seeking additional capital from your bank, you might consider other options. One such option may be to have existing owners provide the additional funding themselves. Alternatively, you may consider bringing in a new owner who can bring additional equity into the business. Another option may be to liquidate any non-core assets to provide the additional capital. Step 5, identify what government support is available through stimulus packages and support programs. By and large, this is something most businesses will already be well across. The main programs currently on offer include JobKeeper, Cash Boost Payment, loans, industry-specific grants or concessions, and payroll tax concessions. In the event you have not investigated your eligibility into any of the above packages, we recommend you contact your accountant, as they will certainly be able to assist. Step 6, continue to update and monitor your cash flow forecast regularly. This is imperative in establishing where your business stands at any point in time. Understanding now that you will likely have a cash deficiency in 8 weeks' time gives you the opportunity to take action in advance to address the deficiency. That is surely better than not realising you have a cash flow problem until it happens. And lastly, develop a business rescue plan. Firstly, be sure to implement the cash flow measures we've discussed today. Secondly, engage with your key stakeholders sooner rather than later. And thirdly, register for our next webinar, which will discuss what your rebuild plan should consider due to the impact of COVID-19. In summary, it's fair to say that business owners have never dealt with anything like COVID-19 in any of our lifetimes. One of the positives to emerge from the pandemic has been the financial support and goodwill that has been provided by the ATO, our banking institutions and our key stakeholders. And whilst that support and goodwill has been very welcome, it will soon be coming to an end. Those business owners who have used the time during the pandemic to make improvements in their businesses and plan for life in a post-COVID-19 world will likely be better placed to deal with what will emerge once the support packages provided by the ATO and banks come to an end. No doubt you will have heard in the press that Cairns has one of the highest rates per capita outside of the capital cities of people receiving JobKeeper. That tells me two things. Firstly, and not surprisingly, Cairns businesses have been disproportionately impacted by COVID-19 due to our exposure to the tourism industry. And secondly, when the ATO and banking institution support packages are wound back and ultimately cease, our local economy will likely have a harder landing than most. If you have not already done so, our advice is that you should be engaging with your key stakeholders now and take advantage of the goodwill on offer and, when necessary, involve your accountants and advisors in those discussions. Our feedback is that only a small percentage of businesses have plans in place to survive in a post-COVID-19 world void of government and bank support. The question for you is whether or not you have a plan. And if the answer is no, what are you going to do? Because time is running out. As mentioned at the start of the webinar, we will be hosting a follow-up webinar next Wednesday, the 23rd of September, titled Surviving COVID-19, Planning the Rebuild. The details for registering for this webinar are displayed on the attached slide. In addition, we'll also be hosting a one-day cash flow forecast workshop in our offices on Wednesday, the 14th of October. In this workshop, we will help you build your own cash flow forecast spreadsheet that you can use in your business on a daily basis. If you have any questions from today's presentation or you're interested in registering for next week's webinar and/or our cash flow forecast workshop, please contact our events team on the phone number displayed on the screen or email us at events.nq@bdo.com.au. That concludes our presentation, so thank you for tuning in and please enjoy the rest of your day.